All right, guys, let's go have a look at the first required in this particular case study. All right, so from what they've given us in the question, they say prepare the journal entries that Cable has to process in order to account for the foreign loan. Okay, so firstly, the foreign loan and its financial records for the year ended 28 February 2018, as well as 28 February 2019, as well as 28 February 2020. Ignore tax, do your journals in order, journal narrations not required. Okay. All right, so the fact pattern says that you're the CFO of Cable, a company specialized in the distribution and manufacture of extensive range of electric cables. The company imports and manufactures electric cables, and Cable has a 28 February year end. And the company's functional currency is South African Rand. Great. Okay. All right. So Cable has a long-standing relationship with Chongqing or Changhong, a company situated in China. And they've supplied Cable for many years with quality CW. However, due to the increased shipping costs, Cable has no alternative other than to start building its own plant to produce the white sulfur. Cable informed Changhong at the commencement of 2019 financial year that Cable will stop purchasing its HDCW wire from Changhong as soon as the planned plant has been completed. And Changhong was saddened by the news, but offered Cable the funding to enable Cable to build the new plant. In turn, they would require Cable to supply Changhong with 40% of the output. This will decrease the shipping cost for Changhong to meet its other Southern Hemisphere customers. The arrangement will also benefit Cable, who will have the capacity to supply them with the 40% of its output once the plant is completed. Okay. Then they give us on the 1st of March 2018, we received $240,000 and it bears interest at 10% a year. And you can assume that this is a market-related interest. So therefore, there won't be a difference in our amortized cost. And these interest payments are payable annually in arrears, but the capital is repayable at the end of Feb 2020. Okay, and then they give us all these exchange rates. Okay, so from an exam technique point of view, guys, I know I stress this a lot, but it is quite important. Set up your timelines. So we know the required has asked for 28 Feb 2020, as well as 28 Feb 2019, which means our opening will be 1 March 2018, which also just happens to be the date that we got this particular loan on. Okay, so on that particular date, we received $240,000. Now, guys, when you have foreign exchange transactions like this, I've said it before, but my advice is definitely set up or reconcile that particular account in Forex first. Okay. All right. So on 1 March, we get the loan and our balance will be $240,000. Okay. We know that there's a 10% interest per year. So on 28 Feb, we're going to have a 10% interest charge, which is then $24,000. Okay. And then we will also, on the 28th of Feb, we will pay the interest of $24,000, which then leaves our closing balance for year 1 at $240,000. Okay. Then the same thing for year 2, we've got the interest accrual also of $24,000. There will be a payment at the end of, so that's not a minus, that's a plus because we add that to the loan. We're going to pay this interest at the end of year 2. And in addition to that, we also are going to pay the capital, okay, at the end of Feb 2020 of $240,000, which then gives us a closing balance of 0. Okay. So now that we've got that, guys, it's quite easy to go and apply your exchange rates. Okay. So we know your transaction at the 1st of March, you'll use the exchange rate at the 1st of March, which will be 12.95. Your interest, because that is something that accrues over a period of time, guys, you will then use the average for that particular period. So here they give you that average of 12.375. Okay. Our payment happens on a particular day. Right, so because we pay that at the end of the year, it will then be the spot at the end of the year. So at the end, that will be 1180, end of year one, 28 Feb 2019. Okay, so that gives us our closing balance at the end of the year, and our closing balance will also be translated at spot at that particular date. Okay, our interest for year two multiplied by the average rate, which is going to be 13.225 for year two. We then make the payment of the interest, which will be the spot rate at the end of the year, 14.65. And our payment of the capital at the end of the year will also be at spot rate on the dates that you pay, 14.65, and our closing balance will be translated at 14.65 as well. But we know that the closing balance in Rand is going to be 0. Okay. So now, guys, now that we have that, the calculations are quite easy. So 240,000 times 12.95 gives us a 3,108,123. 24,000 times 12.375 gives us a 297,000. 24,000 times 11.8 gives us 283,200. And we know that our closing balance should be the 240,000 times 11.8, which then gives us 2.832 million. Yeah. So now we know, guys, we've translated all of these components in Rand, and there will be a misbalance in this Rand account, and we know that that misbalance is then going to be our Forex difference. Okay. So if we go, let me actually just make that minus for simplicity. So if we go 3,108 plus the 297 interest minus the 283,200, it then gives us a 3,121,800. Okay, but we know that the balance should be 2,832. Yeah, so therefore you will have a Forex loss of 289,800. Oh, sorry, that will be a Forex gain. 289,800. Okay, because it's making your liability smaller. But we follow the same process then in year two. Okay, so year two, 24,000 times 13.225, going to be 317,400. Okay, we pay this at the end of the year, which is then going to be 24,000 times 14.65, which gives us 351,600. And of course, we have a payment of 240,000 times 14.65. So that will be 3516123, but we know the balance should be 0, so there will be a misbalance, which we know will be Forex. So 2832123 plus 317,400 minus 351,600 minus 3516123. That is then going to give us a Forex difference of 718,200. Now this is obviously a plus, so that will then be a Forex loss in this case because you're making your liability bigger in this particular case. All right, guys, so now that you've got the calculations, the journal entries are quite easy to go process, okay? And we'll go have a look at those now. The only additional thing that I want to point out, ladies and gents, is you'll remember when we covered IS 23, we had the definition of borrowing costs. And it is in the case where you obtain financing and you have borrowing costs in order to construct a qualifying asset. Now, a qualifying asset is an asset that takes a substantial period of time. So if we go look a little bit further in the question, and you guys would have covered this already in your reading time, they pretty much tell you that we then got the plant and equipment and all of that, and the plant is a qualifying asset, And the borrowing costs directly attributable is 37,125. And we also know that the plant was then completed or signed off by the engineers on the 31st of August 2018. Okay, so in total, we capitalized 37,125, and that would have been in the 2018 year. Okay, so if we go back to our solution or our workings, it would have been here in August somewhere. Okay, so we know that there's a part of the interest in this year, or specifically this interest here, that is then going to be capitalized. So we just need to take that into account. We're going to capitalize 37,125. Now, they were nice enough in this question to give you that particular number. Normally, they could have easily made you calculate it because you know the date in which you took out the financing. And you also know the date on which the plant was ready for use. Okay. So if we have a quick look at the solution, okay, so like we said, on day one, we got this loan in, 3,108. So we raise a loan and it comes in through bank. Okay, so bank loan 3,108. Nice. Okay. We then have the next component, which is then obviously an interest accrual, which we know is 297. And we also know part of that is capitalized. Okay, 37,125. So they've done this all in one journal entry where they've said, okay, well, your P&L is going to be the remainder, and on your plant, you're going to add the 37,125. If you add those two numbers together, these two numbers come up to the total of 297 that you would have calculated. Okay. All right. Back to our calculations. We said that there was a payment of 283,200. Okay, so that is there on the solution, the payment. And the only thing that is left, guys, is our foreign exchange. And we calculated this as a forex gain of 289,800. What you will see they've done is they've just taken both of, or they've split that over two journals. So if you take the 276 plus 13.8, you will get the same 289,800 that they get. So literally all they've done is they've just calculated separately the forex movement on the capital as well as on the interest portion. Okay. Okay. In year two, okay. In year two, we know that there's an interest component of 317,400, and we paid 351,600. So from a journal entries point of view, we paid 351,600. There's an interest of 317,400. Okay. We then paid the capital portion of 3,516, which they give you this as an alternative, 3,516. That's what we paid at the end of the period. And all that we have left now to account for is our forex loss of 718. And again, they've split up the journal entries. So we have, they've got a 684 plus 34.2, which then the total of those two foreign exchange losses give you what we calculated, a 718,200. Okay, so overall, nice question. The only snag really was that the information relating to the capitalized finance costs were separate in a separate part of the question, but I trust you guys would have picked that up in your reading time. Okay.